Welcome to everyone who is on time. We're going to get started in just a few moments. You can bear with me for 60 seconds or so. We'll let people trickle in. I see folks coming in now. Thank you again for being early. We'll get started in just a moment out of respect for your time. All right. With that, we'll go ahead and get started. Welcome everyone to today's presentation on behavioral finance. Fun topic for you today. Behavioral finance teaches us that our emotions and cognitive biases can significantly influence our investment outcomes. By recognizing these tendencies and adopting proactive strategies, we can navigate the markets more effectively, we believe, and achieve our financial goals. We're very pleased to have you here today. Thank you all for being here. My name is Josh Brockwell. I'm Investment Communications Director here at Azad. Just a quick note that today's webinar is being recorded. I'm confident that you'll benefit today from the information that we provide. But first, let's get the disclaimers out of the way. This discussion is not meant as a one-size-fits-all piece of investment advice or recommendation. It's for educational purposes only. Therefore, we highly recommend that you speak to your financial advisor for information specific to your situation. On your screen now, table of contents, a look at what we'll be discussing today. First, we'll do introductions, both of our panelists who have assembled here to impart their wisdom, as well as a brief overview of Azad Asset Management. Then we'll dig right in, looking at behavioral issues when it comes to investing, and then we'll talk a little bit about how you can guard against some of the biases and emotional issues that are part and parcel of investing. Lastly, we'll take a look ahead at some upcoming webinars, invite you to those, give you a heads up, and tell you how you can get in touch with us if we missed anything today. Your speakers are on the screen now. With us today are Fatima Iqbal, Raj Mahmood, and Ihab El-Elfi. First up, Fatima. Her educational background includes a degree in applied economics and management from Cornell University, complemented by a master's in finance from the Rochester Institute of Technology. She holds the prestigious designation of Certified Financial Planner. Fatima possesses specialized knowledge in halal investing and Islamic inheritance and estate planning, reflecting her commitment to addressing unique financial concerns within the American Muslim community. Next up, Raj Mahmood. Raj is a graduate of George Mason University with a degree in decision science, appropriate enough for today's subject, and management of information systems. Raj started his career in finance in 2005 and has gained extensive knowledge in financial planning through his work at various financial firms in the DC region. Raj holds the Certified Financial Planner certification as well. Last but not least, Ihab El-Elfi. Ihab began his financial services career in 2005 with the Ameriprise, where he served as a paraplanner and associate financial advisor. He spent 6 years there before joining Wagner Lee, LLC in 2012 as a financial advisor under the broker-dealer Raymond James. A graduate of the University of Maryland, Ihab earned a Bachelor of Science in International Business from the Robert H. Smith School of Business. His goal is to help clients through each stage of their financial lives by providing sound advice and clear communication, and by building lasting relationships. All three are Azad advisors with decades of experience in the industry, and they're here today to talk to you about behavioral finance, as we said, including some of the pitfalls investors face and how to deal with them. As I mentioned before, I'm Josh Brockwell, Investment Communications Director at Azad. I'm responsible for all things marketing and spearhead our shareholder advocacy program. Next up, a brief word from our sponsor. Azad Asset Management is a financial services, halal financial planning financial firm founded in 1997, based outside Washington, D.C., $1.5 billion in assets under management. And we offer again, financial planning and halal investment solutions to American Muslims across the United States. We don't like to toot our own horn too much at Azad, but I will note that we have been named to the Financial Advisor Magazine top IRA list. We've been named to the Financial Advisor 100, the FA 100 by CNBC, and several of our investment strategies have also gotten individual recognition, including by PSN Top Guns, a major ranking database in the United States. And most recently, our Zodwise Capital Fund, the first halal fixed income fund in the United States, received 2 Lipper Fund Awards for 2024, Best International Income Fund over 3 years and 5. Turning back to today's webinar, our objective is to help you recognize biases and irrational behaviors that can hurt your financial well-being. And most importantly, what you can do about them. After attending today's webinar, you'll understand the following: why we have behavioral biases and what they do to us, how our biases and emotions can affect our financial decisions, how to create an action plan to take the emotional decision-making out of investing, and how your Azad advisor can serve as your strongest defense against these biases. Now let's move on to the heart of the discussion, the mistakes people often make when investing. These are errors that are driven by human nature and can significantly impact our financial being. With that, I'll turn things over to Ehab. Ehab, over to you.
Thanks, Josh. Let's begin by understanding what behavioral finance is. Unlike traditional finance theories that assume investors are rational, behavioral finance studies how mental biases can affect financial decisions and market outcomes. And we know from an Islamic spiritual sense that our nafs, or our ego, can be our greatest enemy. This extends to our investments as well. Allah tells us in the Quran about the mischief of the nafs and its effect on our own success. He tells us that he would not change a favor which he had bestowed upon a people until they change what is in themselves. Now, based on a 30-year study on how behavior affects investment returns, here are some highlights. Attempting to time the market has caused the average investor lagging the S&P 500 over the last 3 decades. Impatient and irrational behaviors tend to penalize portfolio performance. Maintaining a long-term perspective aligns better with performance fundamentals and principles of behavioral finance. Now you can see on the screen the impact of unnecessary moves in and out of the market. The return on an initial $250,000 investment was $347,000 less than if the investor just stayed in the market. And of course, we get it. Investing can be stressful. If you look at market history over many years, there's always a reason to panic and sell. But what does that get you? The average investor 30-year annualized return was just 5%. Meanwhile, the S&P 500 returned 10.5% annually over that same time period. That's a difference of 5.5%, which shows the damage done when investors trade based on short-term views and attention-grabbing headlines.
I will jump in here very quickly to piggyback on something Ehab said. I've put on your screen now a list or a chart showing intra-year declines versus calendar year returns for the S&P 500. There's a lot going on this chart, but suffice it to say, we'll just simplify it. It's important to understand that it's impossible to predict where stocks are going to be in any given year. And the performance of any given asset class can have drastic periodic changes. That's basically what this chart shows. It is looking at the performance of the S&P 500, basically large company stocks, over the last 40 years, or from 1980 to 2020, which is a 40-year period. It shows us a couple important things, including, as I mentioned, that general nature of the behavior of large cap stocks, which is up and down. The dots on the screen represent the low points in the S&P for that particular calendar year, while the year-end values are represented by the bars. So obviously there's a lot of variation. So there's a few things we can take away from this chart. First off, stocks move around. Volatility is a part of investing. It's a roller coaster ride. You got to embrace it. And also, not every year is going to be a positive. Sometimes large cap stocks like those of the S&P, by the way, don't perform as well as other asset classes. And that's where diversification can also be your friend, though it can't protect against a loss, of course. A diversified portfolio, though, is a good way to mitigate some of the risks associated with investing in just large cap stocks alone. But as we've talked about already, our biases and emotions can prevent us from rationally incorporating these ideas into our investment practices. And that's where, for a lot of us today, if we're of the Islamic faith, I think practicing Muslims know that in times of hardship, we should exercise tawakkul or reliance on God, and also patience, sabr. It's also very important. Allah mentioned reliance in the Quran 38 times, patience 69 times as keys of success, especially during difficult experiences. And we know those difficult experiences can extend to our finances, God forbid, but even in market volatility. Reliance or tawakkul means that you make your best effort and then you count on God without doubt or anxiety that he's going to choose the best path ahead for you. For more on biases, again, here's the ad.
Yeah, everyone's affected by their emotions. At Azad, we work with all ages. Social scientists have identified common characteristics of each generation today. We try our best to understand each one of them and help them avoid behavioral pitfalls. Someone in the silent generation or the baby boomer tend to be more skeptical, or they worry about losing everything, right? Whereas a millennial tends to look at what's trending and often take extreme gambles. Both outlooks and behaviors can have damaging effects on their financial success. We take the time to understand each different outlook and create a financial plan suited for each one of our clients. For more on the source of the biases, let's turn to Raj. Raj?
Thank you, Ab. Can you guys hear me okay?
Yep.
All right. Welcome, everybody. So let's first address, and we must first accept that as humans, we are actually not wired to be successful investors. That part of our brain does not exist. Part of the brain that does exist, however, is the limbic system, which is responsible for our safety and it protects us from harm. This part acts on instincts. For example, when you instinctively pull your hand away from something that's burning or hot without consciously thinking about it. You instinctively attempt to protect your body in a car crash, or if you see an object flying towards you. You didn't think about it. It was not a conscious decision you made. This was actually your limbic system's rapid processing of danger signals. It was a reflex action before your conscious mind has time to process the situation. The part of the brain that's responsible for conscious thinking and reasoning is the prefrontal cortex. The conscious reaction is one that involves deliberate thought and decision making. For example, planning a vacation, getting ready for an exam, career planning, and even financial planning. All these examples involve research, preparation, analysis, and evaluation before you take action. So why is this important? The limbic system can lead to several biases in our financial decisions. As investors, we instinctively want to protect our money from loss or decline. We've all heard the saying, you buy low, you sell high. However, most investors do the opposite. Why? Because when the stock market declines, our limbic system wants to do what? Protect us from harm and loss. Now let's take a look at some of the biases caused by our limbic system and how they can impact our investment decisions. Regret and fear. During times of market volatility or economic uncertainty, fear can grip investors, leading to panic selling or irrational decision making. Selling investments when the market is down can lock in losses and prevent investors from benefiting from potential recoveries. On the flip side, overconfidence, the limbic system can also drive feelings of greed and overconfidence during a bull market. Investor may become overly optimistic about certain investments, leading them to take on excessive risk. See, it's very easy for us to feel overconfident. If I was to ask you, raise your hand if you think you are an above average driver, I bet all or most of you would raise your hand. But we know that can't be true, and statistics tell us otherwise. We can feel that same overconfidence when investing in a bull market. See, rising tide raises all boats, but you may think you are the one impacting your portfolio's returns. Anchoring, getting stuck on a specific reference point. For example, you go to a car dealership and you look at the initial sticker price and it's usually a very high price, and it anchors in the buyer's perception of the car's value. Even if they eventually reduce the price, the initial high anchor can influence the buyer's willingness to pay. Herding, following the crowd, can also lead to buying at a high price. FOMO, fear of missing out. You invest in a trendy stock simply because everyone else is investing in it, fearing you'll miss out on potential gains regardless of the stock's fundamentals. And when our instincts and biases toward fear and greed meet today's 24/7 news cycle, bad things can happen. The media can significantly impact our behavior and our financial decisions. We all know the media has its own agenda. The job of the media is to do what? Induce fear and greed. Media's coverage of the stock market can easily lead to panic selling or even buying. Headlines about market crash or recession can cause investors to sell investments out of fear, leading to further decline. The main point is, it's best to be careful when we consume media. And a rule of thumb, less is more. To mitigate the negative impact of the limbic system on investment returns, it's essential for investors to recognize and manage their emotions effectively. This can involve developing a disciplined investment strategy, maintaining a long-term perspective, diversifying to spread risk, and staying informed through independent research, not emotional impulses or market hype. Additionally, working with a financial advisor can provide guidance and proper perspective to help navigate these complexities of the market with greater objectivity. Remember, we are investing, for most of us, for 40 to 60 years. It's a long journey. And you are trying to fund probably the biggest liabilities of your life: retirement, taxes in retirement, and healthcare. And as Josh mentioned, this journey will require sabr and tawakkul. Now, with more on some of the pitfalls we've helped clients navigate, let's turn over to my colleague, Fatma.
Thank you, Raj. So as investors, we have to understand, of course, there are things that we can't control, right? Things like when markets go up and when they go down. But successful investors focus on what they can control. And one of those big things is our behavior. So successful investing can seem hard, we get it, but it doesn't require genius, and nor does it require some exotic investment return. One of the critical factors is to understand the psychological pitfalls and learn to avoid those behaviors. So I want to share with you 3 common mistakes I've seen with clients over the years so you can understand what to avoid. First up is selective memory. The selective memory is the tendency to remember only certain information and forget the rest, especially when it's inconvenient. Now, who wants to remember a painful event or experience in the past, especially one that was of our own doing? In terms of investments, we certainly don't want to remember a bad investment decision, and especially those that have proved to be mistakes that ended in losses. The more confident we are, the more such memories of mistakes threaten our self-image, and we think, how can we be such good investors if we made those mistakes in the past? So instead of remembering our past accurately, we tend to remember it selectively. So again, it suits our needs and preserves that self-image. If we see ourselves as skilled traders, we often adjust our memories of the poor investment decisions we've made, and we might just think, maybe that just wasn't a bad decision after all, or maybe I didn't lose as much money as I had thought. And again, over time, our memory of the event will adjust to fit the image we have of ourselves, even though, again, it may not be accurate. And unfortunately, this can lead us to overestimate our investment skills and maybe take some unnecessary risks, even against the advice of our investment professionals. Now, many investors will also focus obsessively on one investment that's losing money, even if the rest of the portfolio is doing well. And I've seen this with my clients. This is a behavior called loss aversion. And it's been shown that while investors are more likely to sell a winning stock in an effort and excitement to take profits, they're often unwilling to accept defeat in the case of a losing stock. And some market observers have said that more money has probably been lost by investors holding a stock they no longer wanted until they could at least come out even than for any other reason. Now, regret also comes into play with loss aversion. And again, it may be difficult for us to distinguish between a bad decision and a bad outcome. We regret a bad outcome, for example, a stretch of weak performance from a stock, even if we again chose that investment for all the right reasons. And in this case, regret can lead us to make a bad sell decision when selling a solid company when its price is low, instead of doing what we know we should do, which is buy more of it. And there are thousands and thousands of stocks out there. As investors, we really can't know all of them. In fact, it's actually a major endeavor to really know even a few of them. But we're bombarded with stock ideas, whether it's from the television, as Raj was mentioning, magazines, websites, dinner party conversations. And inevitably, some investors might decide that the latest idea that they've heard is a much better idea than the portfolio that they already own. And that will cause them to go and make a trade. But of course, in many cases, a stock comes to our attention as a general public because it's had strong previous performance, not because necessarily the stock has improved in its underlying business. So following a stock tip under the assumption that others have more information is actually just a symptom of following the herd. And again, as Muslims, we know that Allah has warned us against making decisions merely by following the herd or the majority. And in the Quran, in Surah 6, Allah subhanahu wa ta'ala tells us, and if you follow most of those upon the earth, they will mislead you from the way of Allah because they follow doubts, and they are not but falsifying. So we can all be much better investors when we learn to select our investments carefully and for the right reasons. Again, consulting with our financial advisors and then actively blocking out that noise. Because any comfort that we get in investing with the crowd is going to be temporary. Same thing if we follow a market guru. Ultimately, that can lead to fading performance or again, inappropriate investments for our particular goals. Now, let's shift focus and take a look at 5 habits of successful investors to overcome these biases. Now, the first habit of successful investors is to invest as soon as possible, and that's to take advantage of compounding. It's no reason why Einstein called compounding the most powerful force in the universe. Now let's take a look at the example on your screen now. Here we have a case of Cindy and Charlie, each who are investing $100,000. Charlie immediately begins depositing $10,000 a year for 10 years in an account that earns a 6% rate of return. Very reasonable rate of return, not some astronomical return number. And then after 10 years, he stops making those deposits. Now, Cindy, on the other hand, waits 10 years before getting started. Maybe she felt that she had other, financial obligations. She wasn't able to save enough. Whatever the reason being, she's waited 10 years to start. And then she starts to invest $10,000 a year for 10 years into an account and also earns a 6% rate of return. Now, remember, Cindy and Charlie have both invested the same $100,000. But Charlie's balance is higher at the end of 20 years simply because his account has had more time for the investment returns to compound. And here's the second habit of successful investors, which is don't time the market and to invest consistently. Now, you may notice that most people will accumulate the most money in their 401k and employer retirement plans. And again, it's not because those accounts have some superior investment performance. It's simply due to the fact that people automate their contributions each pay period and are forced to stay consistent, whereas sporadic investing of lump sums can rarely achieve similar results. Now, investors typically wait for good news, and by the time that happens, they've often missed out on some of the strongest days of market performance. And as you can see, missing out on those big days can make a significant difference in your long-term return. As this chart showing you, a hypothetical investor who missed just the best 5 days in the market over the past 4 decades could have reduced their long-term gains by 38%. And someone who missed the best 10 days could have undermined their gains by 55%. Now, rounding out our top 5 habits of successful investors, another important one is don't invest in things you don't understand. You should know how that investment is going to make money, how long your time horizon should be, how liquid that investment is, what legal protections exist for you in case something happens. So be able to understand your investment beyond the simple jargon, enough to explain it even to your grandmother. Because again, you won't be able to stick to your investment plan if you don't understand it, especially when times get difficult. Also, remember, don't invest money that you're going to need in the short term. Investing always carries risk. So again, don't forget that no matter how appealing the return might be, make sure you take your time horizon into consideration. And finally, don't confuse luck with skill. Sometimes people get lucky with individual investments. Maybe you remember Bitcoin or NVIDIA or the AI craze of recent months. But again, that doesn't mean that now you're a professional. Economic conditions can change, your circumstances change, and your asset allocation and risk level should adjust to your life changes. And one more tip, avoiding emotional traps starts with awareness and discipline. So we as Azad advisors coach our clients to create a personalized investment strategy aligned with their goals and risk tolerance. That means tuning out the noise and trying to keep your plan on track. And your Azad advisor helps ground you and reason with you again when emotions can take over. Again, in addition to all the other things that you see on the screen right now. And when emotions start to cloud your judgment, having that support can help you stay accountable to your goals. And as an Azad advisor, we create a personalized investment strategy aligned with your goals and risk tolerance, not anyone else's. We're using research-proven strategies and our experience to plan smarter moves to fit your situation. And again, when times are difficult, you're going to want an advisor who's been through tough times to help you assess those risks realistically and tune out the hype driving the bad impulsive decisions. One of our most important jobs as advisors is acting as a behavioral finance coach. And during hard times, just sticking to an investment plan, regardless of how well designed it might be, can be challenging. So we're here to help our clients make better choices and stick to their plans by coaching them through these difficult times, not chasing the herd or reacting to headlines.
Thank you, Fatima. And let me also add here, just to piggyback on that, on the subject of financial advisors. Aon Hewitt, Morningstar, Vanguard, some big firms out there all place the value of financial advice at anywhere from 2 to 3% per year in excess returns. And Russell Investments, I put that on your screen here today, puts the potential value of advisors at over 5%. That's as of last year. The largest component of that total value, by the way, comes from behavioral coaching, which Fatima just alluded to. In other words, helping you to avoid the pitfalls of emotional investing, those pitfalls that often trip us up. And of course, the peace of mind that comes from having a trusted advisor is truly priceless. That's going to bring us to the Q&A portion of today's webinar. Please use the Q&A feature in Zoom to ask away. It's going to be a great opportunity to dive into some of the biases we've talked about and talk a little bit about our advisors' experience with these sorts of issues, looking at some anecdotes, some case studies along the way. We'll start just to kick things off with a question for everybody on the panel today, and we'll go back. We'll start with Ihab, then Raj, then Fatima. Can each of you name a time when a client demonstrated one of the biases that we've discussed today, and can you explain what you did to help correct that? Ihab, again, we'll start with you.
Sure, no problem. Yeah, I would say selective memory and following the herd, but I'll start with selective memory. Selective memory. I had a client a couple years ago. He often criticized his friend. His friend lost $1 million. It was like 900, so close to $1 million buying speculative stocks. And very critical of his friend. And I said, what about your behavior? And he's like, what do you mean? See, he's the kind of client that always panics, gets in and out of the market. I mean, he's been calling World War III since 2016. So just to get an idea. So I showed him, if you had stayed in the market, stuck with your original financial plan, not only would you be closer, $1 million higher than you are today, but his financial plan's probability of success would have been closer to 90%. And at that time, it was currently below 55%. So I think that delivered the message, and ever since then, he's been sticking to the plan.
Awesome. Let's jump over to Raj. Do you have an example
Yeah,
of this?
Many examples come to mind, but one specifically was a client who was actually a physician. She's actually also a primary caretaker for her mom, so time's limited for her. And post-COVID, if we all remember, there were a lot of trendy stocks, kind of stay-at-home stocks that were doing really well. And her friends and family were advising her, instead of having Azad manage her money, to have her do it herself, because there's a lot of opportunity out in the market and she could do much better on her own. And then I recently spoke to her, and she actually didn't change. She realized she didn't have the time, she didn't have the know-how, the willingness to do it. She decided not to follow the herd. And in my recent conversation with her, she shared this with me and said that a lot of her friends and family who did follow a lot of those trendy picks were very remorseful. So that's a good example of somebody who didn't follow the herd and is very happy with her allocation, her risk tolerance, and her financial plan.
Yeah, that's a good one. And that's starting to rear its ugly head again today. I'm noticing, like, even, looking at the meme stocks coming back again. I mean, AMC and
Yeah.
GameStop are in the news. And it's
Yep.
funny because in just, I think, this morning's Wall Street Journal, there was an article about anchoring and the effect that has on folks who are speculatively getting into GameStop again. And like a lot of these meme stocks going back to like the 2021 valuation, whatever the valuations were. I mean, I guess it was bid up to, in excess of, I can't remember, many multiples of what it is currently. And they're saying, they mentioned it in this article about, Danny Kahneman, who recently passed away, talking about the idea of anchoring. And people are saying, well, that must be the true value, as opposed to looking at something that a traditional market participant would look at, like earnings, either on a trailing or go forward basis. They're anchoring it to that 2021 value and thinking, well, it must get back there at some point. So, yeah.
As opposed to looking at the fundamentals, right? How's GameStop making money? How's AMC making money? Is that sustainable? Yeah.
For sure. Yeah, Fatima, let me turn it over to you for an example of a bias you've encountered with a client and how you've talked him or her down.
Yeah, I mean, I think a similar example, which I guess also shows how sometimes investors can get overconfident. I have a client who again has done a really good job about saving consistently, has taken advantage of retirement plans for his small business, pension plans, consistently invested. We've been able to stick to the strategy and hasn't panicked, during market downturns. So again, a client on a good track, on track. And he attended a party and he met someone who started telling him about, again, these stock trades that he's made, and he's made a lot of money. And so I get a call from this client starting to ask me about these different stocks. And, again, this is very unusual. So I asked him, kind of, where is this coming from? And he said, well, I was talking to this person and they were telling me how they've made all this money, and I realized, like, I haven't done any of this, and maybe there's some money that I think stocks that I could be buying too. And I said, okay, well, what does this person do? And he said, well, this person, they work in this particular industry.
Some other industry, not finance.
It was not finance. It was not finance related at all. And so it was actually somewhere. It was related to information technology. But I said, well, if they've made so much money doing this, why aren't they doing it full time then? And my client paused and said, oh, okay, yeah. I mean, I said, well, he told you about all the great picks that he made? Did he tell you about any of the companies that have lost money? And so I think that with that, my client realized that, he was really kind of experiencing that fear of missing out. And he also wasn't getting the full picture. People often tend to talk about their winners. We don't tend to want to talk about mistakes that we've made. And again, you realize that, he had actually done very well sticking to his strategy, and he had done it with a lot less stress as well.
Yeah, sounds like some selective memory coming into play there for sure. There was another question we received before we started the broadcast today on the subject of reliance and sort of turning things over to God, that idea in Islam that you tie your camel and then trust in God. And we referenced it briefly in the formal part of the presentation today, the idea of tawakkul, or reliance, when you invest. And, broadly speaking, we can talk a lot more about this offline. I don't want to monopolize the time today. But generally speaking, if the question is how to exercise reliance in investing, there are a few sort of broad categories, boxes that you would consider checking in order to have met that requirement of tying your camel before you can trust in God. One is when it comes to investing, making sure you have the right talent to manage the portfolio. Doing your due diligence, making sure that the investment team has the appropriate qualifications, the registrations, experience, track record, etc. For the halal part, obviously, make sure that the team has expertise, tools, things of that sort. You can always ask for references, by the way. Make sure that you understand the investment strategy and that the strategy is simple and clear. Going back to that idea that Fatima alluded to earlier, you should be able to explain it to your grandmother, buy what you know. Obviously, make sure that the advisors have performed and delivered over time. Ask for proof of authenticity when it comes to Sharia compliance, asking for guidelines and verifying that the processes and procedures have been approved by an independent third party. Quick question for Fatima, changing gears. How do I respond to fear of market drops now that we're at or near all-time highs? Obviously, a lot of news today. The Dow hit 40,000 briefly. It's an important psychological milestone, they say, even though it really has no bearing on anything if you're an institutional investor. How would you respond to someone who's afraid that now that we're at an all-time high, the bottom's just going to fall out?
Yeah. So I think, something that you referred to at the beginning, that, whenever you invest, we understand that the markets are going to go up and down. At the same time, markets never go up forever. They never go down forever. And so we have to be prepared, again, that there will be market volatility. We can't escape it. So we have to embrace it. Now, how do we embrace it? That's where it's really important to understand what your risk is. And we can manage portfolios, again, with various levels of risk. So the idea here is, while you can't eliminate risk completely, we can manage risk and we can avoid any catastrophic risks. And I think that's what a lot of investors fear, is that catastrophic risk, that everything is going to go out from under my portfolio, then what? And having a well-diversified portfolio, different sectors, different portfolio managers, different asset classes, all of this can help. And we know that it works because, again, we've been through various different market cycles. We understand how markets work. And again, that's why it's important to go back to what you know, not always relying on just what you feel. Because again, having that strong understanding of how markets behave, again, going back and understanding that, we have to be conscious in our decisions, not just, making emotional decisions, that can help us make sure that we stay on track. And especially with something like retirement, that's not something that you want to mess with.
Perfect. Yeah. And obviously we can talk offline with the individual questioner about their situation. If they're in retirement, obviously a little less time to make up for losses, but still a lot. If someone's, early in retirement, you're still looking at, maybe another 20, 30 years. So holding on to stocks in those situations actually pays off. We have a lot of literature we could share, including charts and graphs around how stocks perform once they've hit all-time highs. Even a time frame as short as 12 months out, more often than not, they're up after that period of time once they've hit that all-time high. So they actually do pretty well. It's not really, there's no technical reason for stocks not to continue to do well. Sometimes, again, there's just a psychological barrier. So Ehab, I'm going to jump over to you if you have a moment. There's a question about the best strategy for retirement funds and whether or not that strategy would vary with the amount of capital one has at their disposal. Can you jump in with a response? I'm sure it's going to depend on a lot of variables.
Yeah, and it's a question being asked that they have the funds already and how do they invest it. So yeah, it'll be a case by case, but yeah, I would say the time frame, what their financial goals are, because if a goal is modest, we don't have to be as aggressive, right? If the goal is aggressive, then you're going to have to stay aggressive even throughout retirement, at least at a moderate aggressive level. But yeah, it will be a case by case, and we can explore that offline to your specific case.
Hey,
I saw another
Rob,
question. Sorry to cut off. Yeah. The idea of when the market is crashing, the need of feeling like you need to do something, right? And that's kind of goes to what Raj was saying earlier about the limbic system. It causes that panic and anxiety, fight or flight mode. So you have to do something. You can't stand still, right? But if you just have to think logically, and it's very hard to do that, right? You have to take your emotional brain off the table, turn into the logical side, maybe take a walk, just calm down a little bit. I know that's hard, but from a logical standpoint, if you think about it this way, there are two negative outcomes that could happen. One, you stay in the market continues to tank. Painful, right? The other is you get out of the market, but the market skyrockets. It starts to recover. Which one's worse? The latter, because of that lost investment opportunity, you can never make that up. Whereas in the former situation where you stay in the market, you feel that temporary pain. As long as you're patient and see it all the way through, eventually the market recovers, right? So yeah, try to in any other situation, try to get out of the emotional panic side and think logically. Call your advisor. We can help calm you down as well.
Yeah, that's great. I mean, I think there's a lot that goes into that, right? I mean, some of it goes back to what Raj was talking about and kind of controlling our media diet a little bit more, not always being so super concerned. And yeah, there's that old saying, don't just stand there, do something. Really, with investing, a lot of times it's the inverse. Don't just do something, stay in there. And that actually can help pay off longer term. Raj, I wanted to bring you in again. There was a question about AI, obviously another trendy subject these days. It's powered a lot of the market over the first several months of the year. The question is, can you invest or should you invest a certain percentage of your money in emerging stocks such as AI?
So again, we have to look at the fundamentals of the company, right? If it's a company that's done very well, has a track record of success, and now they're implementing AI as part of their business, yeah. But otherwise, if it's a new up and coming trendy stock, then you have to just be, like you said, reliant and do your own due diligence and research. And this is where working with an institutional money manager or hiring somebody who's a professional can really help, right? They have the resources, they have the know-how, they have the CFAs on staff, they have the research, and they can do a proper fundamental analysis of a business to see if this company has long-term growth potential. A lot of that we don't have the capabilities to do on our own. So if you were to invest in something that's trendy, it would be an impulse. It wouldn't be because of any due diligence. And this is where a lot of research has to be done before you actually take action. And going back to the other point about the market, I just want to kind of highlight just the last 6 years, and these are just recent, right? So I still remember, 2018, middle of 2018, we were hitting market highs, and then ended 2018 with a negative year. Then 2019, market rallied, we hit market highs again. But then beginning of 2020, what happened? COVID, global shutdown, market hit all-time lows, and then soon after it rallied again. And we're hitting market highs towards the end of 2020 and 2021. And then in 2022, inflation kind of took over and market started pulling back. NASDAQ down 30%, S&P down over 20%. And now in 2023 and 24, guess what? We're hitting record highs again, right? So that's just recent last 6 years. I'm not talking about 2008, 2001, right? That seems like ancient history at this time, but just keep that in mind, is that even if we hit market highs, there's still more opportunity. And if things pull back, it's not the end of the world. Markets are resilient as long as you own good quality, fundamentally sound companies.
That's a lot of good perspective.
And I would just add to what Raj is saying. I think again, those investors that have been successful, even over those 6 years, have been those that have invested consistently. Those that have continued to invest even during those dips. Of course, they've seen their portfolios do well, in the market rebounds. But again, the people that again tried to wait until markets got better or things were better often missed out on some good market returns. So it's not rocket science. It's about consistency and time, and those are going to be much more powerful for your investment performance, even more than investment returns.
Yeah, that's great. Both of you. Thanks for that perspective. I think that really helps. And look, a lot of what we're talking about today, I think in terms of biases, people might feel like that we're asking them to ignore their emotions or something of that sort. And clearly that's not the case. I mean, we're all human beings. People feel their feelings. But I think what we're ultimately driving at is this idea that you can acknowledge it, understand that it's a normal feeling, but then ask yourself whether or not responding to it in the way that you want to respond is the best course of action, right? And that's where that behavioral coaching comes in that you talked about, Fatima, and we got a question earlier about the need to feel like they always have to do something. Sometimes it's just a conversation with an advisor who can really kind of appeal to that prefrontal cortex that Raj was talking about before. Go ahead.
Yeah, it's just awareness, right? It's just recognizing it, being aware of these biases, and then you're right, just having a conversation with somebody who's a professional to help you in making the right decision for you and your future.
And I would also say the other important thing that we do as advisors is we do a lot of the work ahead of time, right? We don't get on our bike and wait to put on our helmet until like we feel like the bike is shaking or about to hit a bump. We put it on ahead of time. And so that means making sure that your plan is in place regardless of whether markets are going to be going up or down. And when you do feel that urge that you need to do something, there are some healthy things that you can do. You know, you could rebalance your portfolio. Maybe if markets are down, that might be a good time to rebalance. It may be a good time to check in with your advisor and review your financial plan. Are you still on track? So there's a lot of things that we still can do, but in a healthy way, not necessarily just reacting because of how the market is behaving.
Yeah, perfect. I will jump in here with a toss-up. It is a question that it's pretty broad, but I think that the lessons could be valuable for those who gathered with us here today. The question has to do with the biggest mistake that a long-term investor can make. Any thoughts on? I mean, obviously we've highlighted a lot of the biases, the pitfalls and failings of emotional investing. If you're a long-term investor, what can you, maybe each of you, a big mistake or maybe the biggest? It's hard to quantify, I'm sure, but Ihab, let me bring you in first.
I mean, we could use COVID since it's recent. Yeah, selling when it's it's easy to sell. You're following the herd. I had several clients that sold near the bottom. I tried to convince them. I think I saved a good more than I could. But yeah, you sell. You think about it. You're selling. The market is starting to rise. You don't believe in this rise. You're like, no, it's going to come back down again. They keep waiting and waiting, and it just becomes a harder and harder decision to get back into the market. That's like 40-50%. How is that going to affect their financial plan, right? So that would be one example for sure.
Yeah, a great one. Any other thoughts, Raj, Fatima, before we jump ahead here?
Just don't gamble with your retirement money, right?
Mm-hmm.
I think that, if you're ultimately looking to fund, like I said, your biggest liability, and it's not your children, it's not your home, it's not, your day-to-day and your monthly bills, it's going to be your retirement. Don't gamble with that money. Put it in the right allocation with the right risk tolerance, implement it in a right plan. And yeah, that would be my advice.
Yeah, and I would just add, for long-term investors, time is your biggest friend. So use that time wisely. Invest, earlier. The earlier you can start investing, the better. Even if it's less, find an amount that you can invest consistently, even on a monthly basis, within your retirement, outside of your retirement. Stick with it. I think, again, my clients who have been most successful, when we open up their accounts and they see what they've been able to accomplish, they've done it, and it hasn't been that painful because, again, they stuck with a strategy that was easy to maintain. So again, it's not about finding big amounts of money and finding the best investment return out there, but again, just using time to your advantage.
Appreciate it. That's sage counsel. Appreciate the wisdom and expertise from everybody gathered here today, our panelists. What a great group of folks. So we are nearing the end of the presentation, but we do want to take the opportunity to inform you all about our upcoming webinar schedule. Our next webinar will be on halal investing, obviously an important consideration for our clients. And in July, we'll be doing our annual mid-year check-in with Fiducian Advisors, our outsourced chief investment officer. So please be on the lookout for more information soon. That's going to conclude today's presentation. I'd like to thank our guests, Fatima, Raj, and Ihab, And a special thank you to all of you who took the time to be here live with us today. If we didn't get to your question or if you'd like more information, please do reach out to us. The email address is hello@azadasset.com. Also, be sure to follow us on social media. The handle for our Facebook, Twitter, and YouTube accounts is @AzadFunds. You can find us on LinkedIn under our full name, Azad Asset Management. Thank you again, and have a great rest of your day. Thanks, everybody.
Thank you, everybody. Bye.